Hello everyone, in this video, I'll explain why using proper money and risk management is required to become a profitable trader. Because this is the most important part of trading, preventing you from blowing your account and getting wrecked. Most professional traders don't risk more than 1% of the account per trade. If you have a $10,000 account, your stop loss should not cause you more loss than $100 if it hits. Position sizing. First, decide where you are going to place your stop loss before taking an entry. Is your stop loss far? Then you should reduce your position size for the trade to avoid losing more than $100 if the stop loss hits. Can you place your stop loss very tight? Then you could take a bigger position to still risk $100 if the stop loss hits. How to use leverage. If your stop loss is very tight, you may be allowed to increase your position size with a lot more margin than you have. And to do this you need leverage. An example. You have an account with $10,000 and your leverage is at 1x. You found a potential trade setup with a very tight stop loss, but the position calculator shows that the stop loss will cause you a potential loss of $50 if you enter the trade with your entire $10,000 account. Indeed, with risking 1% of a $10,000 account, you are allowed to risk $100 per trade. This means you can even double your position size in this trade while you don't have enough margin. In this case, you are allowed to increase your leverage to 2x to be able to double your position value and open a position worth $20,000. You may also need leverage if you want to open multiple positions. For example, you want to open 5 positions where each position may have a value of $5,000, so you will need $25,000. To be able to do this you would need to set your leverage to 2.5x. The higher the leverage, the less margin you'll need for a position. You could also put the leverage on 5x or higher, as long as the stop loss doesn't cost you more than 1% of your account, and as long as you apply position sizing. Be careful with leverage, because the higher the leverage, the closer the liquidation price will be to your entry. Therefore it is wise to always use a stop loss, and not to use high leverage. A lot of retail traders taking a huge risk by using leverage in the wrong way. This is the reason for blowing accounts. Risk-reward ratio. Only take the trade if the return is good. It's not worth risking $100 if the return is also $100 or even less. Let me explain why. Losing streaks are a part of the game. You win some and you lose some, but the trick is to minimize the losses and maximize the gains. If you use 1-to-1 risk-reward ratio, you have to win 5 trades at least after a losing streak of 5 trades to end up at break-even. Here is where the magic starts with using 1-to-2 risk-reward ratio. In this case, your risk will be $100 for a potential return of $200. Let's say you have a losing streak of 5 trades, this means you have lost 5 times $100, which is $500. But after that, you win 5 trades, which means you won 5 times $200, which is $1,000. And this is the power of risk management. Even with losing 5 trades with a loss of $500 and winning 5 trades with a gain of $1,000, you will end up with a $500 profit. With a risk-reward ratio of 1-to-2, is winning 33.33% of the trades enough for break-even? Don't forget to like and subscribe for more content like this. Click also on the bell to receive notifications when we publish a new video. Thank you for watching and goodbye.